But there are many ways in which speculation may be unintelligent. Of these, the foremost are 1. Speculating when you speculating carry out the instead of as a pastime, when you lack knowledge and skill for it. And 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is in so flat-fed speculating. And every so-called common stock issue or makes a turn. In many ways, similar to design speculating or speculation is always passive. Can be a lot of fun while you are ahead of the game. If you want to try your luck at it, put aside a portion, the smaller, the better. Your capital is never run more than that is the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account. Any part of your thinking results to be expected by the defensive investor. We have already defined the defensive investor as one interested chiefly in safety plus freedom. But then, in general, what course should we follow and what return can we expect under average normal conditions if such conditions really exist? To answer these questions, we should consider first what we wrote on the subject 7 years ago. Next, what significant changes occurred since then in the underlying factors governing the investor expectable return. And finally, what we should do and what we should expect under present day, early 1972 conditions. What we said 6 years ago. We recommended that the investor divide his holdings between high-grade bonds and leading common stocks. That the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component. That its simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments have disturbed it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25% if he felt the market was dangerously high, and conversely to advance it towards a maximum of 75% if he felt that the decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 2% on high-grade taxable bonds and 4% on good tax-free bonds. The dividend return on leading common stocks, with the Dow Jones Industrial Average 892, was only about 3.2%. This fact and others suggested caution. We implied that at normal levels of the market, the investor should be able to obtain an initial dividend return of between 2% and 2% on his stock purchases, to which should be added a steady increase in underlying value, and in the normal market price of the representative stock list of about the same amount, giving a return from dividends and appreciation combined of about 2% per year. The half and half division between bonds and stocks would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. 4. 2. What has happened since 1964? The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 71.2% and even more against 41.2% in 1964. In the meantime, the dividend return on Dow Jones Industrial Average type stocks had a fair advance also during the market decline of 1,969.70. But as we write, with the Dow at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year, bonds during this period. There is a paradoxical aspect to these developments. In 1964, we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline. But we did not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn on page 90 that a long-term bond may vary widely in price in response to changes in interest rate stocks. In the light of what has since happened, we think that this warning with attendant examples was insufficiently stressed. For the fact is that if the investor had a given sum in the Dow Jones Industrial Average at its closing price of 874 in 1964, he would have had a small profit thereon in late 1971, even at the lowest level, 631 in 1970. This indicated loss would have been less than that shown in long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that in theory should have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important bearing on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1971 and early 1972. Toward the end of 1971, it was possible to obtain 8% taxable interest on good medium-term corporate bonds and 5.7% tax-free on good state or municipal securities. In the shorter-term field, the investor could realize about 6% on the U.S. government issues due in 5 years. In the latter case, the buyer need not be concerned about a possible loss in market value, since he is sure of full repayment, including the 6% interest return, at the end of a comparatively short holding period. The Dow Jones Industrial Average at its recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the funds between high-grade bonds, or others are called cash equivalents, and leading Dow Jones Industrial Average type stocks. What course should the investor follow under present conditions, if we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future? First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks and also on an average annual appreciation of about 4%. As we shall explain later, this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. On a before tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds. On an after-tax basis, the average return on stocks would work out at some 5.3%, 0.5. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight of the fact that the interest and principal payments on good bonds are much better protected and therefore more certain than the dividends and price appreciation on stocks. Consequently, we are forced to the conclusion that now, toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course we cannot be certain that bonds will work out better than stocks from today's level. The reader will immediately think of the inflation factor as a potent reason on the other side. In the next chapter, we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds of present differentials in yield. But there is always the possibility that we consider it remote of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable without stepped-up inflation as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't even thought of, might cause the investor to regret a 100% concentration on bonds even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy. For defensive investors, namely the good times, they have a significant part of their funds in bond-type holdings and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components or a ratio dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since it presents the overall return envisaged from common stocks is nearly the same as different bonds, the presently expectable return, including growth of stock values, for the investor would change little regardless of how he divides his funds between the two components. As calculated above, the aggregate return from both parts should be about 7.8% before taxes or 5.5% on a tax-free or estimated tax-paid basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14% or so return shown by common stocks during the 20 years of the predominantly bull market after 1949. But it should be remembered that between 1949 and 1969, the price of the Dow Jones Industrial Average had advanced more than fivefold, while its earnings and dividends had about doubled. Hence, the greater part of the impressive market record for that period was based on a change in investors' and speculators' attitudes rather than in underlying corporate values. To that extent, it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We have done this for convenience, and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities, which have a separate Dow Jones average to represent them. But the major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified and representative risk from another, or more accurately, that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, the Dow Jones Industrial Average advanced from 616 to 839, or 36%. But in the same period, the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously, the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often that the investor cannot hope for better than average results by buying new offerings or offices of any sort, meaning thereby those recommended for a quick profit. Just the contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude this section, let us mention briefly three supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds, or commingled funds, operated by trust companies and banks in many states, or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar-cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it is high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum, in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more amply in later chapters. Results to be expected by the aggressive investor. Our enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. These virtues, if channeled in the wrong directions, become indistinguishable from handicaps. Thus it is most essential that enterprising investor starts with a clear conception as to which courses of action offer reasonable chances of success and which do not. First, let us consider several ways in which investors and speculators generally have endeavored to obtain better than average results. These include 1. Trading in the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here they will sell issues they do not own but borrow from the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal on p. 19 indicates, even small investors perish the term exclamation mark sometimes try their unskilled hand at short selling. 2. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report.
TerraClear delivers detailed maps showing the precise location and size of each rock. Knowing the time required to clear each field, TerraClear's solution allows you to optimize your time and resources. Or if you don't have the labor, or don't have the time, the TerraClear provider will pick for you. From small rocks to big rocks, TerraClear takes care of it all.